Is the dollar's throne shaking? This question is currently the hottest debate in global finance. Crowned at Bretton Woods in 1944, the dollar, which set the language for everything from oil to international trade, now faces its biggest challenge yet. But here's the question, is this a rebellion, or just temporary unrest? Today, I will pursue this question using the data, the numbers, and a little bit of history. Because what's happening behind the scenes is far more complicated than you think. The turning point of this story came on a cold February day in 2022. When Russia invaded Ukraine, the West's response was historic. Russia's central bank had $300 billion in reserves frozen. Russian banks were thrown out of the SWIFT payment system. At that moment, every central bank governor and every finance minister in the world asked the same question, is this an exception, or the new rule? Could our reserves also evaporate in a political dispute? That day, the answer became clear, yes, the dollar can be used as a weapon. And for the first time, the ground beneath the dollar's throne shook that hard. With this tremor, the rebels waiting backstage took the stage, BRICS. Brazil, Russia, India, China, South Africa. Their common grievance was voting power that didn't match their economic size. And now they had the perfect excuse. Why should we be exposed to a third party's currency, its rules, and its sanction risk when trading among ourselves? But creating a common BRICS currency would be a political revolution. They know this. So instead of toppling the throne in one blow, they adopted a strategy of quietly gnawing at its legs. Now let's look at the numbers. What do the IMF's KOFR data tell us? In 2000, 71.1% of world central bank reserves were in dollars. As of the end of 2023, that figure had fallen to 58.4%. A loss of 12.7 points over 23 years. Not fast, but steady. Now let's see where that loss went. Over the same period, the Chinese yuan's share rose from 0 to 2.3%. The euro's share increased from 18% to 20%. The Japanese yen fell from 6% to 5.5%. The British pound stayed flat around 2.7%. But here's what's really striking, only about 2.3 points of that 12.7-point dollar loss went to the yuan. The remaining 10-plus points shifted to what the IMF calls non-traditional reserves, currencies like the Australian dollar, Canadian dollar, Swedish krona, and South Korean won. So the world is moving away from the dollar, but most of the ports it's entering are still Western currencies. This suggests that the narrative, China is rising, the dollar's throne is being taken, is somewhat exaggerated. China's journey to reserve currency status is still in its very early stages. What about trade? According to SWIFT data, the dollar still accounts for over 40% of international payments. The euro is around 35%. The yuan hasn't even passed 3%. China's share of global trade is 14%. So China sells goods to the world, but it can't collect its own currency. Actually, it does collect it, but that currency doesn't circulate globally, it stays in China. That's why China has to maintain strict capital controls to manage the foreign currency entering the country. And as long as those controls exist, the yuan cannot truly become an international currency. The contradictions within BRICS are another dimension of this story. India and China have border disputes. When Brazil tried using yuan for trade with Argentina, China was reluctant to supply goods in exchange for the yuan that accumulated in Argentina's hands. Russia sold oil to India and accumulated 40 billion rupees, but couldn't buy goods from China with those rupees because China doesn't accept rupees. The result? Russia had to convert those rupees back into dollars. You try to escape the dollar, and you end up right back in it. The system imposes itself. Gold is an entirely different story. According to the World Gold Council, central banks bought 1,136 tons of gold in 2022 and 1,037 tons in 2023. This is the highest two-year purchase volume since 1967. China added 225 tons in 2023, Poland 130 tons, Turkey 75 tons, India 50 tons. Why? Because Russia's dollar reserves were frozen, but no one could touch the gold bars in Moscow. Gold is insurance against political risk. But gold also has a problem: it yields nothing. While U.S. Treasury bonds pay 4 to 5% interest, with gold you wait with zero return. So central banks are choosing security over yield. This is one of the most concrete signs that confidence in the dollar is eroding. Now let's look at those four colossal pillars that still keep the dollar standing. First, the petrodollar system. The world's most critical commodity, oil, is still largely priced and sold in dollars. This forces every country to hold dollars constantly. Second, deep and liquid markets. The U.S. Treasury bond market is over $26.5 trillion as of 2024. It is the world's most liquid, deepest financial market. A Japanese pension fund, a Saudi sovereign wealth fund, or a Chinese bank can buy or sell $500 million in bonds in 2 minutes. You can't do that with yuan bonds. China's bond market is large, but foreign investors hold only about 3% of it. There are capital controls, exiting is difficult. This is why the dollar is still the world's only fully liquid reserve currency. Third, SWIFT and financial infrastructure. The vast majority of international transactions pass, directly or indirectly, through banks in New York. This makes the dollar the main protocol of the financial internet. Fourth, safe haven status. When the world goes into chaos, where does everyone run? What happened during the 2008 crisis, the 2020 pandemic, when the Israel-Hamas war began in 2023? The dollar rose. Even in the moments of greatest crisis, the world still trusts the dollar. And we also need to ask this question: is there only market power behind the dollar, or are there other things? The United States has 11 aircraft carriers. It has over 750 military bases scattered across the globe. Why would Saudi Arabia abandon the petrodollar? If it did, the U.S. security guarantee would disappear. Why would the UAE shift to the yuan? Washington's eyes are on it. In 2023, when a yuan-based oil deal was discussed between Saudi Arabia and China, the Saudis said, "We're staying with the dollar for now." What changed? The U.S. offered Saudi Arabia a security guarantee. Money, after all, is about security. And when it comes to security, Washington is still the biggest player. What about the euro? The euro is still the dollar's most natural rival. Its share of global reserves is around 20%. But without political union, a currency union remains incomplete. Germany won't abandon its own fiscal discipline. France won't either. They cannot issue common bonds. So the world's second-largest reserve currency has no single state behind it, it has 20 states. All marching to different beats. In this state, the euro does not have the power to shake the dollar's throne. At least not yet. Digital currencies represent another dimension. China's digital yuan has reached 260 million people and has been tested in over 200 scenarios. What's the goal? To eliminate intermediaries in international payments, to bypass SWIFT. Technologically, it's possible. Politically, it's difficult. Because the digital yuan means the state sees every transaction in real time. Is the world ready for that? I doubt it. The US, meanwhile, is deliberately moving slowly on a digital dollar. It doesn't want to take risks while the current system is working. But if a digital dollar arrives one day, the game will start all over again. Because technology could restore the dollar's old power, multiplied. Now, about future projections. A 2022 IMF study suggests that if current trends continue, the dollar's reserve share could fall to 54 to 55% by 2030 and around 50% by 2040. But this is a scenario, not destiny. Because these models cannot fully price in U.S. geopolitical power, military deterrence, or the unrivaled depth of its treasury bond market. Also, while the dollar's share declines, the pie itself is growing. Global reserves were $3 trillion in 2000, today they exceed $12 trillion. The dollar's share has fallen, but the amount of reserves held in dollars has increased. That's an important nuance. So what should the average investor do in the midst of all this? First, it's necessary to understand this: the dollarization does not mean the dollar's value will drop to zero. It means we are closing the era of monopolistic hegemony and entering an era where the dollar will have to compete with other currencies. This means volatility for the dollar's value, uncertainty. In this environment, the classic investment advice still holds: diversify your portfolio. Not just into dollars or gold, but across different asset classes and geographies. Other reserve currencies like the euro and Swiss franc, stocks, bonds, and of course physical gold, these can all be parts of a balanced portfolio. But remember, this is more than a financial trend. It is a sign that the world's geopolitical map is being redrawn. Money is the language of power. And that language is now learning a new accent, a new grammar. In conclusion, is the dollar's throne shaking? Yes, more than ever. But this tremor heralds a slow and steady transformation rather than an instant collapse. The dollar will remain at the center of the global system, but the number of other currencies competing with it, cooperating with it, and sometimes challenging it will increase. When we look back 20 years from now, I think the 2020s will be remembered in global financial history as the painful years of transition from a unipolar system to a multipolar one. To succeed in this new world will require flexibility, multifaceted thinking, and closely following change. Because there is no longer a single king. Now there is a council of princes. And every decision taken in this council will affect the fate of the global economy, and therefore, all our wallets. In our next program, we will discuss the potential effects and opportunities of these winds of change on the Turkish economy. Until then, keep your eyes on reserves and your ears on the markets. Goodbye.